To the AJ Brown Show, where we talk about all things investing, options trading, and the like. Now here's your host, AJ, whose primary mission in life is to help you become a better investor.
Hello and welcome back, everyone, to another episode of the AJ Brown Show. My name is Cyprian Francis, and with me, as always, AJ Brown. Merry Christmas, Happy Holidays, AJ.
Same to you, buddy. Happy holidays. Merry Christmas your way.
That's right. I was a little worried last night because I was flying into Chicago, as you could see with my background, and there's this huge blizzard that's taken half the country by storm. That's really kind of slowing down the holiday travel.
Did you have delays?
No delays. Kudos to United. Very, very solid experience across the board. But it's -5 where I'm at right now. So it's, unheard of territories. With that being said, we've had some pretty interesting economic news come out this week. It's a Friday before a Christmas weekend, which is kind of rare, I think, when you look at the history of calendars.
Yeah.
What are you seeing? What are your thoughts? We did the holiday episode, the holiday markets. Are we seeing holiday markets today? Or are we actually getting some movement from this economic data?
I mean, I think that folks pretty much have actually shipped out, haven't they? I think that folks are, they're not sticking around. There's an early close today in the markets. And a lot of people have already, the volume we're seeing here is very little, despite getting the personal income and outlays report. So if we take a look at the personal income and outlays report from today, just a few hours ago, let's click on this here.
Well, so real quick, AJ, what does the personal income and outlays report tell you?
Well, this is a indicator that was made popular by Alan Greenspan about 20-something years ago. And it's one of the Fed's favorite indicators to understand inflation or deflation. And so personal income and then personal consumption expenditures are what the raw data is. And then they have this algorithm that comes up with the personal consumption expenditures price index. And then they factor out things like food and gas, which gives us this one over here, the core personal consumption expenditures price index. And so that core one is, when he talks about that 2% target, they're talking about this number right here, the core PCE price index. And they're looking at it year over year. So you can see that right now they're expecting 4.6. It came in a little bit hotter at 4.7. They're trying to tamp that number down to supposedly 2, although there's a lot of questions around whether that 2 number is actually anything. And we'll be talking about that later. But you can see that last time it was at 5. So maybe this rash of interest rate hikes, one after another, boom, 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 not seen since 1970s, right? Maybe that has now started to have some effect because things are slowing. Actually, when you see a 0.3 of a point slowdown in 1 month, that's actually some effect. So this is probably a pretty positive PC personal income and outlays report.
So inflation, like the things that the Fed is doing is slowing down inflation, and it's starting to come in line. But we did have the GDP number, right? And so I believe that was stronger, meaning that we're still producing as a country. And so we haven't slowed down in that respect.
Not necessarily a bad thing, by the way, the GDP report being strong, because what that's telling the Fed is that they can still do more without worry, because one of the big worries is that the Fed is going to wind up kicking the economy into a recession. And so the GDP is strong. Now, these are revised periodically, and this is the last revision of the Q3 numbers. So we haven't even been talking about Q4 numbers, but the Q3 numbers are very strong. And I dug into this report, and you want to know what's really interesting is along with this report, let me go ahead and back it up a notch. along with this report comes something called corporate profits. And you'll notice in my little economic calendar, because it has this little black dot, it means that it's not really market moving, but it comes along with the GDP numbers. And when I delved into this corporate profits number, corporations have been making a fortune, right? And so it's a combination of them extending prices over from the wholesale inflation that we're seeing on commodities. So, of course, that's raising prices. But when you dig down into this corporate profits number, SIP, it's really interesting. They've been kind of taking advantage of the hysteria. Like, there's these talks of inflation. So people are kind of expecting higher prices. So the corporations seem to be raising prices even more than they have to, because they can, because all this like news about inflation is giving them the perfect time to raise prices. Does that make sense? Corporate profits are through the roof right now.
Yeah, it was like, I think we talked about this in a previous episode, is like, where's the raw materials and Netflix raising their subscription rates, right? That's just like an example of, because
I mean, that's a blatant example, isn't it? But it's all across the board. It looks like corporates are going to have a record profit year, which is probably good, because it looks like 2023, if we don't get a good handle on the corrections we're doing to the economy, those profits could get eaten into next year if we get into some sort of recession.
So then the consensus is our GDP. So that was quarter over quarter, 3%. I mean, that's pretty strong in terms of.
But it's they revise, they go back and they look at the numbers 3 times. And this is the final revision of quarter 3 numbers. So we're not even talking about October, November, and December yet. We're still looking back at, September, July, August, and September. And so quarter 4 is going to be significant for us. But they're just going back and saying, well, we looked at quarter 3 one more time, and quarter 3 was very strong. And, a lot of those profits that we're talking about are coming out of people's credit card debt and their savings. So there's going to be a point here where, especially on durable goods, people are going to stop buying durable goods. We'll see what happens.
All right, so then we've got some interesting economic news that's hitting the wires, and we're in this holiday lull or lack thereof volume and follow through. Mm-hmm. So what is the market telling us? What are we seeing in terms of where are we at with the S&P, and maybe how is this playing into the VIX? I imagine the lower volume just makes the VIX a little bit less interesting, because it is kind of one of those products that is a direct result of the action in the markets themselves.
Well, first off, people were looking for a Santa Claus rally, kind of the rally of people going out with consumerism and buying retail goods. And as you can see from my little chart here, we have anything but a Santa Claus rally. And I think you can kind of kiss that one goodbye. Now, we see something pretty interesting that I mentioned on one of our previous shows. When we get close to the holidays, and then between the Christmas holiday and the New Year holiday, a lot of folks check out for a week or 2 weeks, meaning a lot of the folks who drive the market, the investors, and they leave behind the folks that are kind of, I guess you would call them intense personalities. They would have to be intense, wouldn't they, for them to not want to take some time off at least once in the year to spend time with family. So you've got kind of these people. And when I think of an avatar that would fit the type of person that hangs around, I think about Ebenezer Scrooge, right? Kind of that business person who, can't even have a moment of personal life. And so when you leave those people in charge of the markets, those people trading, you kind of get some neat trading in between Christmas and New Year's. Sometimes it's a stall, sometimes it's a rally. The main thing for our investor friends to know is that it's not to be trusted, because as soon as people are done with their celebrations and they come back in the first week of January, everything gets recalibrated. So don't make any special midterm or long-term decisions based on what you see going from probably today all the way through like the first week of January. Just let that ride. If you want to do some quick like day or 2-day trades, great, but don't make any big, medium, long-term trades based on what you're seeing.
So then I think most of us would agree with that. So then because we're getting close to the end of the year, what's the consensus story of, you know, how 2022 has been looking in terms of the overall market?
2022 looks like it wasn't as weak a year as people would have expected, but things are not looking positive for 2023.
Because
And
it looks like we're kind of where we started the year off. I mean,
let me go back to a whole year chart here. So people expected us to really like fall flat on our face during 2022, and there was a lot of, you know, small rallies that kept us kind of in a sideways, choppy overall broad market look. But 2023 looks like there's gonna be some continued sell-off, continued downtrend.
And then the VIX is, I'm assuming just this month is probably
Calm.
pretty, yeah, relaxed.
So this is our overall average down here. And so we're at the lowest, which means confidence is coming back, right? When the VIX gets low, it means that investor confidence is returning. And so you can see we're just ever so slightly above that line. That line is just under $20. And we're trading at 21, 22, sometimes as high as 23. But for the most part, folks are kind of getting into the groove of the slowdown. Now, if you think about it, the Fed has been doing these extreme tightening measures, right? We know that they've got the two tools. They've got the one tool, which is interest rate hikes. And they've been hiking interest rate hikes at a rate that we haven't seen since when I was a kid, 1970s, 1980s, right? And that's when inflation was crazy out of this world. I mean, you would be lucky if you could get a mortgage at 11 or 12%, right? Right now, people are freaking out at 6%. When I was a kid, getting a mortgage under double digits was like, you were amazing. You had perfect credit and stuff like that. So back then, when inflation was really out of control, that was the last time we saw some Fed maneuvers the way we are now. So this is unprecedented in like the last 40, 50 years, because I'm turning 50 this year. So with that said, with the Fed kind of doing these type of moves, housing, we definitely saw this past week. There was a lot of economic news about housing. Housing has taken it's getting a couple of pummels, right? It's already showing signs of slowing and weakening big time across the board, not just in certain cities, but across the board, especially with mortgage rates kind of fluctuating and slowly going higher, despite some of the anomalies of seeing it pop back down because investors are running into bonds. Overall, they're going higher and higher. And then in addition, the markets are definitely feeling the effects. But what's not feeling the effects yet is prices and wages, right? And we see a little bit, but prices are still high, wages are still high. And so the Fed's got more activity to do. And that they're right on that line of can we get a soft landing or not? It's going to be tricky for them. I don't envy their position.
Hey, and we're just going to continue to keep an eye on things. And if the market is going to take a turn in 2023, our job as educated investors is to take advantage of that, and is to use these tools that you're such a big fan of, which are options, to either hedge your portfolio, take advantage of downturns. And what we want to do real quick is invite everyone to your daily workshop, where you basically break down these strategies. So if anyone watching or listening for the first time hasn't gone and checked this out, I just threw a link into the chat. If you want to learn about what AJ's talking about, if you want to learn how to use options to hedge your portfolio, to take advantage of opportunities, this is a great place to start. It's completely free. I believe you can schedule it for a time that works best for you. Head on over to the link, sign up there. Also, we're pretty light on our stock picks in our speed round today. So if anybody's watching that wants us to review something, throw that ticker into the chat and we'll see if we can bring it up. Otherwise, we're going to take a little break here, come back, and give you guys AJ's pick of the week.
Yeah.
I get it. You're afraid of trading in the markets. Guess what? I've got your answer. I've got 4 strategies I'm going to give you, along with the tools to make it super easy. I'm going right home, giving you the webinar. I need you to sign up below and meet me in a few minutes.
All right.
Before we do the pick of the week, I got to ask you a question. Do you think that the Fed can win back credibility? So the Fed, with that whole discussion, now you might remember this, SIP, it was just last year, transient, this inflation is transient, it's going to go away, the supply chain, it's going to go away. And the Fed has always been not the Fed, how about this most recent iteration of the Fed has always been making these errors on kind of the being too dovish, right? And so they didn't raise rates for the longest time when the economy was growing incredibly fast. And now they're playing catch up. And the problem with playing catch up is that you do have to do these monumentally fast or repetitive high interest rate hikes, which could damage the economy. The ideal way to control the economy is, number one, don't mess around with the quantitative easing, which is what they're doing behind the scenes. But number two is to go slow with interest rate hikes, because it takes a certain amount of time to see how your movements affect the overall game. It kind of makes me think about, I think you know this about me, SIP. I'm a scuba diving instructor. And I teach specifically, now that my time is so limited, I teach quadriplegics and paraplegics. That's my favorite kind of client to work with. We do adaptive scuba classes. And underwater, there's this thing that we deal with called buoyancy. And you add a little bit of air to your buoyancy control device. It's this vest that basically is a bladder of air to help compensate for any sort of weight and your wetsuit, depending on whether you're in cold water or hot water. Because if you're neutrally buoyant, you're not floating up to the surface or sinking down to the ground. You're just kind of floating there. So it takes a lot of experience to be able to get neutrally buoyant. And a lot of times what happens is that you add a little bit of air to your buoyancy control device. And if you don't give it enough time, and it's usually like 5 or 10 seconds, which underwater can seem like an eternity, but it takes 5 or 10 seconds for that to have any effect. And you can tell like a new diver, because a new diver will add it, and then like a second later add some more. And before you know it, they've over added and they've shot to the surface, which could be not only hilarious, but it could also be dangerous. So, it's like, when I think about the Fed having to add just little amounts of interest rate hike and then seeing the effect, I think about my scuba divers. And because the Fed was so late and so wrong, and they've admitted this, Jerome Powell has admitted this, they've had to play catch up with these big puffs of air, right? These big interest rate hikes all at once, and they're not letting a chance for the effects to take hold, for them to actually, stop and take evaluation of what has happened. And so there's a very large chance that they could overcorrect and throw the economy into shambles. And so, and that's what everybody's afraid of, that they're overcorrecting because they were too late, they were too slow. And how does the Fed, first of all, why does the Fed keep making these mistakes? Because this is not new. And second of all, can the Fed win back its credibility? What's your thoughts?
I'd overshoot. I think that historically that has been the case, right? Like we have a lot of instances of that.
Yeah.
And it may be kind of a short term. We may have a quarter that is a little bit more funky than not. But when I look at the U.S. economy compared to world economies, I kind of feel at ease in the sense that, all right, well, it could be a lot worse. And these are the mechanics and the systems that we figured out for our market, because there's still like war going on, right? There's war in places, right? And so just that stability, even if they overshoot a little bit, I feel like the market is smart enough to start to catch up. And so, I mean,
do you trust the Fed? Like, that there's these people who meet in a closed door and then they make big changes to the way that we all.
I know, but like, what's the alternative? What's the alternative? Crypto?
Well, I mean, I guess I feel like there's a huge credibility issue, and I'm trying to figure out what would it do? What would it take for the Fed to win back the credibility? And I think on my side, they've already said that, hey, we should have acted earlier, but I almost feel like the Fed needs to, first of all, they can't, even though economists are saying that this 2% number, that if you look at the history of this 2% number, this 2% number came from New Zealand, right? New Zealand very slowly and very measuredly got their economy running at a 2% rate every year. And it created a beautiful thing across their whole country. And that's one of the reasons why all these other countries adopted 2%. They said, we want to have a country that's growing just at the right rate to be as nice as New Zealand is. And so we've all been targeting 2%. It's just kind of a made up number, right? And so they've mentioned 2% again, and that we've got to get 2%. I think one thing that's really important is that they not change that number. Even though people are saying, hey, it's a made up number, change the number, that would immediately lose credibility if the Fed's like, well, we couldn't get it to 2%, so our new number is 3. So I think they have to stick with that number. That's a given. But another thing they have to do is they just have to I think they have to, be authentic and explain, like, why do we keep overshooting? Why do we keep thinking that the market is better than it is? Why, show the analysis mistakes, show the forecasting mistakes, and show why they were so late. Just explain. And I think that would go miles for building up Fed credibility, because right now we just think they're a bunch of yahoos that can't get it right. That's my 2 cents for the day.
Yeah, I always I mean, not always, but because I'm a little younger than you, I don't have I don't have experience with the higher interest rate, just like overall economy, right? So
right.
When you look at it, when you say used to getting a mortgage under double digits was my generation is over 3.5%, over 4% is an issue, but historically that's more in line with the average number.
Right.
So I think just the consumers understanding that and accepting that, it's just a way of, cycles throughout history and whatnot.
Sure. I just think that if this Fed wants to stay relevant and not have things like crypto challenge their control of the economy, they need to start speaking to the people. Explain why they've been getting it wrong so many times over the last 4 or 5 years, even if it exposes some infallibility, because a lot of people think that, the Fed is, maybe I use that fallibility. I don't even know if that's a word, but the fact that the Fed can make mistakes, expose those and explain why. And I think that would go miles.
Well, we'll keep an eye. We are just trying to take advantage of the opportunities that are presented. And real quick, before we head into your pick of the week, let's just remind everybody real quick that you do have a one-on-one program that has been gaining amazing traction this year. I believe you may be maxed out for the remainder of the year. And so if anybody's interested in some one-on-one training for 2023, heading into January, I'm going to go ahead and throw the link into the chat. But AJ's created a phenomenal one-on-one program that will take all these strategies and the 18 plus years of options trading and options education and kind of help tailor a program that best fits you, your style, your portfolio size, so that you can, make better investments, have a little bit more understanding of the risk and the reward going into things. And if you've been following along the show, we like boring names that are consistent, that add up the wins into the portfolio. So the link is there. AJ, any feedback, anything you want to add to the one-on-one program?
I'm so picky at finding coaches to represent us in this program that we just finally ramped up another coach that I think is absolutely phenomenal. But I got to tell you, he's already booked. But we do have openings in January, and I expect those to fill up pretty quickly. But the door is open, and we're having conversations with folks. And so let's get it going, because right now, like we said, if 2023 is a difficult year to navigate, you're going to want to know these strategies in order to make money when the market not just goes up, but how to make money when the market goes down and sideways as well. And we really specialize on using options to their fullest. Not just, a lot of people come to me and they're like, well, I know how to trade options. And I find out that they really don't know how to trade options. They know how to substitute stocks with leveraged options, which is like freaking kindergarten play. But do they really know how to trade implied volatilities? Do they really know how to take advantage of theta decay? It turns out they don't. So now is when you want to know that. You want to know how to put yourself on the correct side of the equation. So if things do start going sideways or go down, that you could be on the profit side, because the market is just a place where you are exchanging hands of money. So you want to be on the one that's the receiver, not the one that's the giver.
All right, so the link there is in the chat. Just scroll on down and schedule an appointment. Obviously, the holiday week, maybe things will be a little bit slower, but see if there's something in January, maybe even next week as we roll into the new month. You'll get all your answers to all your questions there. All right.
We're doing calls. We're doing interview calls during this week. The only day we're taking off is Christmas and New Year's Day. So we'll talk to you. And we'll get you booked if this is a good match between you guys and us.
All right. So the link is in the chat. We did have a couple of live tickers come into the chat, which we should go over. But before we do that, let's just run through your pick of the week. And this is Pinterest.
I'm back at Pinterest.
P-I-N-S. Yeah.
Man.
I would call this the girlier social media network, because one, I see all the recipe stuff and a lot of fashion stuff on Pinterest.
Yeah. It's interesting. Pinterest, if you think about it, and it had such high potential because, and this is just from a business perspective, people go to Pinterest. If you guys aren't familiar with Pinterest, Pinterest is a social media where you can basically share your dream board. Right? It's a platform where you can accumulate things on the web that you like and that you might aspire to have or be one day, and put it on your dream board, right? And then other people can look at your dream board and get ideas and all that good stuff. And if you think about it from an advertiser's perspective, if you're talking about Facebook or Twitter, you're talking about things that have happened to you either in the present or the past. And so to show you ads about what's in the present or what's in the past is one thing, but wouldn't it be cool if you're showing somebody ads related to their dream board? And so
So I just pulled mine up, AJ,
Yeah.
right? So we got Mike Tyson on here. We got some workout stuff, some movie stuff, some recipes. We got some soccer, some movies. So it does represent, a tad of your own like personality on here.
And so if they had a smart enough ad algorithm, it would just make sense that this would be the ideal place to place ads, in my humble opinion, because gosh, you're putting people's dreams and then you're showing them advertisements on how they can connect to their dreams. The other platforms, like I said, if you're putting up a picture, it's a picture of something that happened in the past. It's done. And so when you're running ads about stuff in the past, you're kind of missing the target. But Pinterest would be so positioned, but at the same time, I don't know if it's how the company is run or how the company is perceived by investors. If I look at this chart, they seem to just be in this sideways scaling pattern. They're not too expensive. They're not our cheapest stock, but they're not too expensive. But I love Pinterest because they are really easy to pull a options income out of, meaning every time options expiration comes, we can have a premium become ours. We can sell a premium, have it expire worthless, and therefore we get to keep that premium that we sold a couple weeks earlier. And I'm pointing out Pinterest because Pinterest is coming down off of a high. And so this would be a perfect time for us to either, for an initial position, to be thinking about either shorting Pinterest, the stock, or buying some put options that are deep in the money, far out in time. This would be our initial covering position. And then when we hit our bottoms around $22, maybe somewhere between $22, $23, we can sell put premium and create those income trades, right? Create those income trades. And so I wanted to feature Pinterest again because we are just right now, and I would say maybe not today because we're going into a shortened day, a holiday. But when we get back after, even during this little break between the two holidays, you might consider either paper trading if you want to get the experience, or even doing just a small amount of setting up an initial position and then starting to collect the premiums once a month, like clockwork. Every third Friday of the month, we collect a premium. So I wanted to feature Pinterest because I think we're missing something there. And by the way, different than a lot of the social media companies. Again, everybody thinks that Pinterest is going away, but Pinterest makes money. It might not be lots of money, but they make money. They make 11 cents per share every quarter. It's been like clockwork. I love cash flowing positive companies versus companies that show losses.
Yeah, and I'm just looking at some of the fundamentals here, and they look strong, especially the institutional buyers. It looks like they've got a kick about 5% in like the last quarter in institutional buying. And as an advertiser who uses the other platforms, I wish I used Pinterest more because I agree completely with you that the potential is there. I just think that at least the people that I work with, the audience isn't on Pinterest.
Yeah, I know. I think it needs to mature a little bit, but I think if any of them is going to last through a hard time, if you've got cash coming, you're secured, man.
Yeah, and as a tech SaaS company, right, in social media, that's really a staple is the cash, especially when you get through all those growth phases. All right, so that's AJ's pick of the week. That is ticker symbol pins. And we've got some live ones coming in. And these are some names that we've discussed recently. And I think people just want some updates. So let's go ahead and start with CCL. I believe that's Carnival Cruise.
Yes. So Carnival Cruise Line, it came back up after dipping down. And so when it comes back up and it hit that same level, This is an opportunity for us to, again, short some Carnival Cruise Line. Either short it, or like I said, you can always buy some back month deep in the money put options. And let me just stop right there. Why would I do that? Why would I buy a back month deep in the money put option? It's because shorting, this is the number one reason. A lot of people would say it's because you want to do some leverage. And I would say that's maybe a frosting on the cake benefit. And I would even do this where I would buy the put options over shorting the stock. I would do this even if the put options were the same price as the stock, which often when you go deep enough in the money, they are. So what's the benefit? Well, it's in the naming, right? To short something, I need a margin account. To buy a put option, I need a cash account. So I can buy put options all day and all night in my retirement accounts. Whereas a lot of margin trades, you're not going to get a retirement account with a margin designation to it. So I would do the puts all day and all night if I can, simply because I can then do this in my retirement account. And betting against Carnival Cruise Line in my retirement account, I couldn't think of a more fun thing to do. And so I would totally be looking at an opportunity to perhaps, if I haven't already, get into some sort of short or back month put option on Carnival, because it looks like, and Carnival's pleasing us with their losses. This is a case where we actually, if we short it, we want the company to do bad, because that way our short position goes up, right? Our back month put option appreciates when the underlying stock goes down. So let this go down. If it stops here somewhere between $6.50 and $7 and pauses and starts to head back up, sell some put premium. Otherwise, just let either that back month put or that shorted position continue to appreciate until you can pull out some nice chunks of money. So Carnival Cruise Line, it's a good one to go against right now, I think.
All right, wonderful. Got another one that we've covered in the past, but I don't know if there's going to be too much action on it, and that's repo, R-E-P-O. This was our conversation about the auto industry hitting, some hurdles, in the sense that too much leverage, to people getting their cars repossessed, right?
Yeah. So yeah, this has been kind of going sideways. It got a little bit exciting for a second there. It doubled in value. This is truly a penny stock. And let me just see if it's not optionable, but it's REPO, right?
Yeah, and I think this was just the play on repos going up.
Yeah. And so the scoop is repos are still going up, but right now there is a oversupply of repossessors. But that's going to change soon, right? Because there's going to be a point where there's not enough repossessors for the amount of repos that are being created. And this all has something to do with the fact that the auto industry really got way into financing. And now all of a sudden, with cars starting to be, coming back on the market, the prices of used cars are coming back down slowly but surely. And so all of a sudden, people have paid like a lot of money for something that's no longer worth what they paid for it. And they bought it on financing. And so they're questioning whether or not they need it anymore, because the payment is more than they could go out and buy a new one of these things. And so a lot of people are going to start letting, just like in the housing crisis, we have a little bubble that formed around the autos. And I think we should keep an eye on this. I think you should keep an eye on repo.
There's not much option action, but it's one of those penny stocks that we brought up because it's interesting. Definitely an economic play there in terms of what's going on in society.
If you're playing a macro play on repos, that might be interesting.
Yeah, and it's a penny stock, so you never know with those returns there. All right, we got another one that I believe we covered last week or the week before, and that's Array Technologies, ticker symbol ARRY.
Yeah. Okay. So array is in this motion. Now I would look at the bigger channel. I wouldn't be, well, I was thinking I would look at this bigger channel from 23 down to 15, but now that I'm looking, I'm going to zoom in a little bit to my 3-month here. $20 up to about $23. One of the things about trading this smaller channel is that you can see that very quickly we move from support to resistance, like in the matter of 3 days. And so if we're using technical analysis in order to help us leg into these positions, that could get kind of difficult. And so because the technical analysis is based on something called lagging indicators. And so if we get an indication 2 days after the bottom has been found, that a bottom has been found, and you've already reached all the way up to the top, that didn't help us very much. So this is one where I would reevaluate my trade plan and see if it makes sense to tighten that up around the, say, 20 to 24, 20 to 23.50 range. And then go back and look at different kinds of signals, because I don't think, like, our fast MACD is not going to cut it, I don't think. Not on this more abbreviated scale. I think you're going to either have to look at some maybe some indicators that involve volume, like accumulation distribution or on balance volume, or maybe even go to a quantitative analysis, look at some buying and selling orders. Some homework you might consider doing is pulling up a point and figure chart and seeing if you see clear reversals and clear support and resistance at those levels. And if not, try to find those levels that you're at. But this could be a premium trade. I'm just saying it's not a premium trade for beginners anymore.
All right. So that's Array Technologies. I'm not sure if we got any other tickers that come to mind. Maybe one that I'm just curious about, and that's Ford. I know that we talked about that being kind of one of those consumer staples that when the economy goes bad, people they tend to weather the storm, but it doesn't look, or at least they're looking like they're going to be hitting some lows here.
Yeah, which might be because it looks like we're coming in for a soft landing. And this looks like a very, very heavy level of support. It's been tested a few times now here at $11. And so I don't want to jump into this now, right? Because that would be, we don't want to anticipate anything. We would rather see something has happened in our rear view mirror rather than guessing it's going to happen, right? But this is not a speculative action. If you're trading speculatively, well, then you're on the wrong call. No, we want to wait and see that this has happened, meaning it has bottomed and it's on its way back up. But if it is, that's an amazing opportunity to start buying some Ford. And this is a really nice price for Ford. Now, I'm also a little bit, and we got to let this play out a little bit, but I'm a little bit concerned that we're making lower highs. So what that creates is a descending line of resistance and a horizontal line of support. And so what it says is Ford is coming to kind of a point. And when it gets to that point, it will want to break out. Now, this is a slowly descending level of resistance. So we could actually sell premium probably for a month or two as this continues to consolidate. Or if luck has it, prices go higher than they did here in the middle of November around Thanksgiving Day, and we break that cycle of descending level of resistance. No matter what happens in the future, though, probably it is a good idea once we get that signal that there's a bottom being found. It is probably a nice idea to add some Ford to your portfolio, even if it is medium to long duration.
Yeah, and they are starting to step up their electronic vehicle game. So,
on the big play, I think that Ford is going to wind up being a big winner in the EV market, both with government incentives that are saying you got to build your EV cars here. Otherwise, we're not going to give people incentives. So Ford's already got that taken care of. But in addition, man, that I would take one of those F-150 Lightnings. And I think, because of Ford being a big company, they kind of are giving smaller companies like Rivian, I think they're putting the nail in the coffins for some of those new startup companies. If they didn't get established like Tesla did, then they better have some special sauce to be able to compete with these big guys that are turning. Chevy's coming out with an electric truck too to compete against the Ford F-150 Lightning, but the Ford F-150 Lightning has hit like a ton of bricks, like really well.
Yeah, and at $11, that's a pretty good price for such a staple.
It's bargain as far as I'm concerned, and they're a cash flowing positive company. They make stuff and they sell it for a profit.
Yeah. All right, we got one more live ticker, and this, I believe, is the silver ETF, ticker symbol SLV, which we've covered a handful of times.
Yeah. So silver has broken out of the channel we were watching. So it depends on how you got. So, it's worth reviewing how we get into these premium trades, because there's two different ways to get into these premium trades. One way is when you're at the top of the channels to set up a either short of the underlying symbol, in this case, the iShares silver ETF, either short it or buy that put option like we were talking about on some of the other candidates. The other way to do it is when it's at the bottom of the channel to go long, meaning buy the stock or buy call options. So it depends on how you set up the initial covering position. If you did the shorting, if you had gotten into these at the top, then there's a couple of things going down. First of all, if you did that, then that means that this other side is when you sold your income producing put option and you bought your protective call. And usually your protective call you buy with a strike price somewhere right up here above your channel. So if that happened, well, what happened? First of all, that put that you sold expired worthless. You got to keep all the money that put generated for you. And now your stop loss order hopefully has triggered, and you are out of that back month deep in the money put option, leaving you with this call. And if you're in a call, you know what happens to a call's price when the stock price goes up. That call is going through the roof. So this position should have self-adjusted for you. Now, if you're the other way around, if instead you got in at the bottom and you sold some premium, well, then that's an easy one too. You're going to get exercised at your max profit. So you know how we calculate that you get your max profit when you get exercised? You're going to get your initial covering position exercised. If you're in a back month call option, you want to check with your broker to make sure they're going to automatically exercise it, meaning you're probably going to get exercised on this front month call option you sold. Will they automatically exercise this back month call option in order to cover the front month call option, or should you do it manually a day in advance so that you can cover this one? Either way, it doesn't matter. Just make sure that this is going to happen automatically or semi-automatically, which leaves you with a protective put. Now, what's neat about these out of the money protective puts is that here's your put strike price, and it's out of the money whenever the underlying symbol is above it. That means that it's parabolic in its price, its profit and loss diagram. That means the farther that the underlying symbol goes out, it's not going to be affecting you dollar for dollar. In fact, at this point, it's probably every time the underlying symbol goes $1 up, your put is only dropping a penny or two. So it's fine to just hold on to that put. You should be, when you purchased it, 3 to 6 months out, so you've got time. And at some point here, if the economy, like everybody's forecasting, goes down and silver goes down, or even just the next time silver takes a little breather, that put will appreciate again. Just be patient and sell that put when it gets to its next high. So either way, this is a good position, and you let it just play out the way that your trade plan told you to.
I'm actually surprised to see that much action in silver. I didn't think it was such a big mover. I thought, that was more of a gold market. So that's interesting to see.
Yeah, and this is the silver ETF, so it's all scalable. But, really going from about $19 up to $21 isn't the biggest move.
Yeah, I guess it just looks a little bit bigger on the chart.
Yeah.
All right. Thank you, Maria, for that.
Thanks, Maria.
So with that, AJ, looks like we're going to be having our last show of the year next week, the last show of 2022. So maybe we'll bring some annual insights to that. Otherwise, we got a half day here. Looks like the market dropped, rallied. It looks like we're going to end the day unchanged, which isn't surprising on a day like today. I believe everyone's heading back, to the families, to the households, to the hometowns, hunkering down for the cold weekend, at least across the majority of the United States. And, hanging, chilling, waiting till next week. Although I believe next week is going to be pretty calm too. Would you agree?
Yeah. Yeah, it'll be a perfect time for us to take inventory and talk about what happened in 2022 and give some insights about what we expect to happen in 2023.
All right. So if anybody watching, listening, has any specific questions on some tickers on an annual level, feel free to rejoin us next week. Drop some names in the chat, hit us in the DM. If you enjoyed the broadcast, hit that like, hit that follow, hit that subscribe button. We appreciate your time. AJ, thank you for, hosting again today, providing incredible insights. Thank you, everybody, for tuning in. Otherwise, everyone enjoy the holidays. Be safe.
Please.
We'll catch you guys next week.
Yeah, on the flip side.
Adios.
Thank you for tuning into the AJ Brown Show. If you're interested in learning more about AJ and his investing techniques, head on over to tradingtrainer.com and create your free account today. And if you're not already a subscriber to the show, hit that subscribe button and we'll get you fresh content daily.